So the healthcare sector, guys, I believe is undervalued here in April 2021. And there are some world-class, rock-solid, dividend-paying companies that are on sale today. Now, as someone who typically likes to buy stocks when sentiment is negative on them, or the market's overlooking them, or they're out of favor, this appeals to me, and this has me interested in possibly opening up some more positions in these healthcare giants. Now, full disclosure, I do own one of them, which I'll discuss in this video, and I'll go through that in this video. But I definitely have my eye on a couple of others, and at these prices, it's kind of hard to resist. Anyways, the momentum seems to have died off with these companies, but I believe over the long term, it'll be back. These stocks are going to do extremely well. These businesses are going to keep doing extremely well. And now is the time to consider buying these stocks. So if you find value at any point in this video, guys, hit the like button down below. It helps the channel out tremendously. And as always, a huge shout out to my VIP members as well for your continued support. Okay, so here's kind of how I broke things down in this video. I kind of broke it down into stocks that I believe are good value today, that I believe go out there and buy them today and you're getting a bargain. And there are some stocks that I think are worth adding to your watch list. May not be the best price today, but if they see a dip in the near future, definitely something to consider. So anyways, we're gonna jump into it now. We're gonna start off with these stocks that I believe are the best value today. Okay, so kicking us off here, guys, is Merck, ticker symbol MRK. It's a pretty big company, and it's showing us some really good value today. We look at the highs here of this company, we were at like $92 per share. At the lows last year, we were down 30%. This year, we actually corrected around 22%, which is a pretty big correction for a company this large. I think at current prices, this one's a steal. It's a bargain. You can see it comes down to these levels every so often, but it is definitely a very strong level of support for the stock. I think this one has a lot of runway to go over time, and I'm going to show you exactly why here. So if we jump over to what Merck is projected to do, you can see this company is going to keep growing. It's expected to grow 9.5% this year, hit over $50 billion in revenue. Next year, another 6% growth, of $55 billion in revenue. This one is clearly a growing business, a very profitable business as well, yet it's being priced like the growth is done for this company. This is definitely something that investors are overlooking right now. This is probably one of the highest conviction plays here for this sector. And if we jump over to analysts here, we'll see that they have a pretty good upside on the stock. Over a 22% upside is what they expect Merck to really be valued at, around $93 per share. Some of the more recent analysts have come up with over $100 price targets on this stock. I think that's definitely something that we'll see over time. And to really get a company that's this strong of a brand in the healthcare space, trading at such a deep discount, you don't see that too often, guys. It's definitely one you want to keep on your radar. Now, Merck also pays out a very healthy dividend, around 3.5%, 40% payout ratio, so tons of room to grow this over time. 11 years of growth, 6.72% growth rate. Everything's looking phenomenal for this business. And here's something specific I want to show you about their dividend. If I go to their yield, we can see that over the last 5 years, we're trading near the highest points we have traded, signaling to me that, this is another indicator that the stock is undervalued severely today. It seems like around the high 2%, say 2.9 to 3% mark is kind of a fair yield number for this company. But here at nearly 3.5%, this one is showing value. Okay, our next pick, guys, on this list is good old Pfizer. Pfizer is, of course, in the news a lot recently because of the vaccines, and investors seem to be kind of mixed on this stock. This is a stock that kind of just moves sideways for long periods of time, and this is another period of time that the stock has been moving sideways ever since, really since a while ago. If you zoom out, it's been in this kind of channel for the last 5-6 years or so, barely moved higher. If you zoom out even more on the time frame for Pfizer, we can see that we did peak out back in 2000s, came down, corrected, and now we're back at those levels once again. Question is, will we break past and move higher? I think so. I think the fundamentals actually support a very good move up higher for Pfizer. If we jump over to what growth Pfizer is supposed to see, as you would suspect, this company is expected to grow nicely this year. They're expected to actually grow by 50% or so this year. And of course, a lot of that's due to the vaccines. Next year, they're expected to actually decline in growth as things start to stabilize. However, it's still going to be much better than what it was a year ago. Last year, The company pulled in almost $42 billion in revenue. This year, 62. So this is kind of an anomaly. But then next year, we're back down to 53. So we're definitely much, much better than where we were before. So to have the stock kind of trading at these same prices here, even though there's lots of growth expected ahead, kind of shows me that, investors are mispricing this one. Again, if we look at what analysts have to say for this, Pfizer has a 12% upside. You may not think that that's that crazy, but I think that's a pretty good price target here for a company of this size, for a company of this magnitude, and of course, for a company that pays out a healthy dividend. Yes, Pfizer also pays out a dividend, guys. Here we can see that their yield, again, is pretty much close to their highs at around 4% or so right now. If you're getting the stock around, that 3.5% range, you're getting a pretty fair value. Anything above that is a good value. Above 4%, it's kind of looking like a steal here with this company. We look at their scorecard to get more information. 4.22% yield, 47% payout ratio, 11 years of growth, and a 6.35% growth rate. So extremely strong metrics here. Better metrics actually than Merck, in my opinion, because they have a higher starting yield. And definitely one you want to keep in your back pocket for, some healthcare exposure if that's something you're looking for. Moving on to the next stock, we have Bristol-Myers Squibb. This is one I've briefly touched on the channel before. It's a stock that doesn't really move a whole lot. It's not a high beta stock. However, it's definitely one you want to add if you're looking for some exposure, of course, but also some good stability. The stock does not really correct all that often. You can see here that last year it did correct with the overall market, but it bounced back much quicker than the overall market. And ever since then, it's just kind of been slowly trickling up higher, kind of in this channel here. It comes back, corrects, hits the 50 moving average, and then starts moving higher. In terms of the growth for this business, it's a fairly consistent company, guys. This one's expected to grow 9% this year, 4% next year. Nothing too crazy, but it is growing, and I think it deserves a lot more credit than what it's getting right now. Analysts here for Bristol-Myers Squibb tend to see this one as undervalued. They see 22% upside in the stock, buy ratings across the board. Some analysts have a higher price target than what the consensus is. I think this should be an easy $70 stock over time. Right now it's at like 63 or so. So this could even end up being kind of like a swing play with a relatively low risk. Now, if we look at what Bristol-Myers Squibb has in terms of their dividends, 3.3% yield, 14 years of growth, 4.62% growth rate, and only a 26% payout ratio. Not too happy about the low growth rate, but they do supplement that with a pretty good dividend yield, 14 years of growth, so they're getting closer and closer to that aristocrat status. And with the payout ratio this low, they can grow it substantially over time if they wanted to. Again, looking at the dividend yield history for this company to show us if it's undervalued or not, we can see this one's trading at a pretty good value. It's not dirt cheap, but it's not expensive either. I think that based on this metric, it's a pretty good value today. We're getting, fair to slightly undervalued. But if you're looking at the company overall with the growth, the profitability, with all of that stuff, this is one that I think should be added to at least a watch list here. The next one up is one of my favorites in this space, and that's Abbvie. Now, I was a heavy buyer of Abbvie when it dipped below $80, $70 around here. I was buying the stock pretty heavy in 2019, bought some more here in 2020, and I believe I even bought some more back here. But we have had a good run on the stock recently. We're sitting at close to $110 per share now. But I still think long term, guys, this is looking cheap. This company went through a merger, which is why there was so much fear and uncertainty and doubt with this company. And some of their patents expiring as well on some of their core products really worldwide. So that added a lot of fear, and I was just like, there's just too much value to pass up on this. If you look at the growth here for Abbvie, 20% expected this year, 6.6% next year. Extremely strong growth company, probably one of the strongest on the list here today. And it's actually why I personally love the stock and own this myself. If you look at what analysts have to say about Abbvie, we can see that even though it has moved up in recent weeks or months, it's still looking undervalued. Almost a 20% upside here in the stock. More recent analysts have come out with even more bullish price targets with like a 35% upside. And I think, over time, this stock is definitely going to be valued much higher than what it is today. Remember, the highest for this company was around 124. They went through a lot here during this time period, but they've come out a much stronger company. So this should be definitely a $120 plus stock over time. And guys, the best part about Abbvie is their dividend. Their dividend is phenomenal. 4.8% yield, 18% growth rate, 41% payout ratio, so tons of room to grow this over time at a very aggressive rate. You may say, okay, it's only been 7 years, but this company spun off from Abbott Laboratories, which has, decades of paying out dividends as well. So they're probably going to continue this for a very, very long time. And if we look at the dividend yield history here for Abbvie, we can see, yeah, this one's trading at a pretty good value here today. Of course, last year we got this stock at close to a 7% dividend yield, which in hindsight was a steal. But even today at like the mid to high fours, you're getting a good value on this company. Now, number 5 here, which is the last one I believe is a really good value today, is good old Johnson & Johnson. Johnson & Johnson is a company that, you can buy at any point in time. Rest assured that you're going to have your capital relatively safe. It's almost like a savings account here that pays you a nice dividend and grows your capital slowly over time. This is not a volatile stock. This is a stable business. It's a company that everyone has recognized as a blue chip business, very profitable company. And right now we're seeing some sort of pullback on this stock, which is why it caught my attention. We jump over to what the outlook for Johnson & Johnson looks like in terms of the growth. 11.7% this year, 4.8% next year, getting very close to that $100 billion milestone for revenue. But what's even more remarkable about this company is their extremely high profitability. They have one of the best balance sheets in the entire world. If you don't look at tech companies, you're looking at companies outside of tech. This may be the best balance sheet out there. There's such a high free cash flow business, there's such a high profit business that it just shows in the stock and how stable it is, because there's never any fear of this company going under or having tough times with their financials at least. Now, in terms of analyst outlook for this company, they have around a 20% upside on this stock. And you'll notice this is a common theme. A lot of these stocks have around 20% upside, which is a really good return if you're looking over a 1 to 2 year time period. But anyway, some of the more recent analysts have come out with a $200 price target here. Actually, Goldman's come out with a $201 price target. But the general consensus seems to be in the 20% range. I think that this one is sandbagging it. Long-term, Johnson & Johnson should be worth much, much more. And of course, Johnson & Johnson probably has the strongest history when it comes to dividends and healthcare stocks. You'll see here they have 58 years of growth, so they are a dividend king. 2.5% yield, which is respectable. 42% payout ratio, so even with paying out dividends for this long, not even half of their money here goes to dividends. So they have plenty of room to grow and a 6% growth rate. Guys, this is a phenomenal business. Dividend yield shows us that we're kind of at a, not necessarily cheap at this point, but because it's a world-class company, you're not going to get it on a huge discount too often. You may get like a high 2% yield every so often when this comes down closer to its 100 moving average and tests that. But that doesn't happen unless there's a lot of fear and uncertainty in the market. Now, Johnson & Johnson has gone through a lot of legal battles over the years, which is why it's kind of been just moving sideways for a bit. But it has pretty much moved past all of this. And of course, they're also one of the big vaccine players here. So long term, guys, this company is going to be a profit generating machine like it already has proven. So it's definitely one that I personally want to have some exposure to. May add this very soon to my dividend portfolio. Okay, so now let's move on to a couple of stocks here that are still good deals for long-term holds. May not be a buy today itself, but ones you want to add onto your watch list for future value. Amgen is the first one here. I have owned the stock in the past, made some good returns on it, but decided to sell out at that point. And I think this one's just going to be a consistent good performer over time. Amgen, if we look at what their growth is expected to be, 4% this year, 3.4% next year, nothing too crazy, decent amount of growth for a company that's, a very stable business, all things considered. If we look at what Amgen's price targets are in terms of Wall Street analysts, they see around a 5% upside, so nothing too crazy again with this stock, which is why I was saying this is not really the best value today, but it's definitely one you want to keep on your watch list. If it pulls back to like the low 200s, yeah, it would be a buy at that point. Now, in terms of their dividend history, they also pay out a nice dividend here. We can see the yield shows us that they're pretty fairly valued at this point. And the scorecard here shows us that they pay out a 2.8% yield, 14% growth rate, 41% payout ratio, and 9 years of growth. So again, good metrics for a dividend growth company. Next up is TMO, Thermo Fisher Scientific. It's a company that we've all heard of, I'm sure, at some point, through schooling and that kind of stuff, but not one that many people really consider as an investment. And I think it's kind of an overlooked company. You can see from the lows in March 2020, it has essentially doubled up here from $250 to over $500 at one point. It's pulled back a little bit now, could be presenting us with an opportunity here. TMO, if we look at their growth expected, around a 10% growth this year, but seems to be contracting next year, negative 3.2%, which is why we've probably seen some sort of pullback here in the stock in recent weeks. And if we look at what the Wall Street estimates are for this one, we see that it seems to be pretty positive. $559 price target, which is a 15% upside. Not too shabby for a company that's already moved up so significantly in the last year. You can see that over time it's kind of been a very steady grower, and then last year just kind of took off, but now it seems to have stabilized a little bit, and we may just continue on this sort of trajectory going forward. I don't think we're going to jump to like $600 in the next month or two, but over time this one is definitely going to be one that's just consistent, keeps growing, provides value, and is one you want to probably add to a watch list or maybe in a portfolio. In terms of dividends here for this company, they pay out a very small dividend, probably the smallest one I've seen out of most healthcare stocks. Tiny payout ratio though, so tons of room to grow this. Paying it out for 4 years, so nothing really to look at here in terms of their history for dividends. But this one, as you can see, is more of a growth type company, right? Like the other ones, we didn't really see as explosive of their stock growth because they pay high dividends. This one, you get the opposite. You get good capital appreciation, but not too much in terms of dividends. All right, the next one on our list, guys, is Eli Lilly and Company. This one is kind of all over the place. It's more volatile than most of the other healthcare plays that we looked at today. However, if volatility isn't an issue for you, it's one you want to add to your watch list. It seems like the orange line here, which is the 100 moving average, seems to be a very good buy point for this stock. We're currently pulling back from its highs here, and we may come back to this 150 level or a good buy long term for this company. In terms of their growth here, we can see that they expect to grow 13% this year and, stay relatively flat next year, 1.3% growth. So nothing too crazy. Profitable business, yes, but investors are looking at the future and saying, this one seems to have, bottomed, flatlined here, so it's not much expected, which is why it's most likely selling off at this point. Now, based on this, you wouldn't expect to see too much in terms of analyst expectations. However, they see a 27% upside in this stock. A lot of them actually see more than that, like a 34, 31% upside, 40% upside in some cases. So a lot of analysts are very bullish on this company. And after this pullback, maybe it makes sense to buy a little bit here at around the 170 mark. Personally, I would probably wait until the 150 mark if I wanted to open up position in this. However, you can see that the outlook is pretty positive here at Wall Street, and that means that big money is flowing into this. Now finally, with the dividend yield for this company, we can see that they pay out a 1.87% yield, good growth rate, good payout ratio, 7 years of growth, combined with a pretty good outlook in terms of the chart and what analysts are thinking. This one's not too bad, guys. Again, one you want to add to your watch list. It may not be a buy exactly here today, but if we come back, fill this gap, pull back a little more with the market pullback or something, could be a very good recovery play for some really good upside with some good healthcare exposure. So guys, let me know in the comment section down below. Do you agree that these healthcare sector stocks are actually showing us value today, or do you believe that their lower prices are justified? Maybe healthcare isn't something that's as exciting anymore for investors, or maybe it's because these large tech giants like Microsoft, Apple, Amazon are entering the healthcare space that has some investors spooked. Either way, love to hear your thoughts in the comments down below. Let me know if you're buying into these companies and what you think of this list. Thanks for watching, guys. Hope you enjoyed this video. Don't forget to invest positively, and I'll see you in the next one. Peace.